Good morning, everyone, and welcome to today's Daily Trader. We're in the middle of big market moves, big economic data, big earnings data, a lot going on in the markets today. Let's give you the macro minute because today, Thursday, we got personal income and outlays and jobless claims. Two pretty significant numbers here in terms of the inflation look. First, personal income. Up 0.3. That's a tenth better than expected, but less than consensus. Personal consumption expenditures, spending, up 0.5. That's a big jump from up 0.2 last week. So generally, core PCE is up 0.3. Year over year, core PCE up 2.7%. That is unchanged for the last 3 months and a tenth higher than everyone expected. So the inflation data, I want to make sure we understand this. It's not coming in hot, but it's not going down like it was. So the inflation data as we see it, especially core PCE, one the Fed looks at, it is stable here. It firmed up and is not moving on the downside like everyone expected. We also got a jobless claims number, 216,000 first-time filers for unemployment insurance. That equates to a pretty strong labor market as well. So we're getting good labor market numbers. The inflation numbers were firm, not hot, just firm. But the 10-year yield now back at 4.3%. The reason stocks are down this morning, you got the S&P down about 1.125%, the NASDAQ down 1.6%. It's Microsoft's earnings, it's Meta Platforms earnings, and today we'll get Amazon and Apple after the bell today. We traded both of those yesterday, if you remember, on Daily Trader. So with that, let's get to today's show. And today's show is a fun one because we're going to look at two EV makers, Tesla and Rivian. Two companies doing two different things at the same time, and we're going to do a trade that's similar in both. We're going to look at paper money trades that are very similar, but I'll show you why they're similar, and I'll show you why they're different in a moment. All right, here we go. First, let's look at Tesla. Now, Tesla just had their earnings, as you know, did extremely well off earnings. Trade as high as $273 and change. Now it's back down around $255 as we get to Thursday morning. And the narrative about Tesla is starting to evolve, which means it's slowly becoming something more than just an EV company. Now, the EV part of Tesla is firming, but still problematic as Elon Musk seems to be sacrificing margins in the current time to outcompete his rivals in the long term. He's using the margins that he has and the advantages that he has to press the competition and really put pressure on everyone. Now, that costs him margins, as you know, but it also gives him more market share because his numbers were actually pretty good, even though the overall EV market has softened. But if you look at a stock like Tesla, it is so much more what it's becoming than just an EV stock. It's got 4 cars and a truck, as you know, but it's also got energy, solar, the Powerwall, the Megapack. It's got charging that is now being adapted by all the other EV companies are adapting Tesla's charging. So they've got that. Full self-driving. Full self-driving, remember, that falls under services, which means it's a subscription service that will keep going. That's really good margins, really good growth in full self-driving. Then the robo-taxi and the robotics, which I have a different view. I thought the robo-taxi event was incredible. Now, it's not perfect. They have to keep going. They have to get it to market, and they have to catch up to Waymo, which is already, if you go to the West Coast, they have cars on the road. So those are all the things positive about Tesla. It's slowly becoming so much more than just an EV company, but there's still some struggles, and Elon Musk's political activism could cause him troubles down the road and distract him. So there's and then there's Starlink, and then there's his rocket company. He's all the other things that are going on in his life that may distract him. But Tesla right now, the China troubles are over, and it looks like Tesla's back on track, even though the stock has come off, let's call it, $17, $18 off its recent highs. So the trade we looked at is something that takes advantage of that. It's the diagonal spread. If you're going to watch this show on a daily basis, I'm going to look at the strategy of a diagonal often because it is something like a covered call strategy as you buy a deeper money call, selling out of the money call, but it doesn't use the stock. It uses a longer term option. I'm going to give you two versions of that today when we look at Rivian in a few minutes. So in Tesla, what I looked at was buying the Nov 29th. So giving yourself some duration here. Nov 29th is 29 days. So you're basically giving yourself 4 weeks for this trade. So it's a little longer term trade, but that gives you the ability to extend duration on the short side. I bought the Nov 29th 255 call, sold next week's. As it's Thursday, the premiums are getting pretty low. I sold next week's November 8th 275 call. So a $20 diagonal spread, right? It's a calendar spread, but not the same strike. It's the 255, 275 diagonal. And you can see what that does is on the chart there is if Tesla were to rally up to 275 or through it, unlike a calendar spread where that graph comes back down, this one stays up. Why? Because of the $10 or $20, difference between the Nov 29th expiration and the November 8th expiration. So this is a diagonal that gives you about 31 deltas. It collects theta every day, and the risk is what you pay for it. If it's trading about $12.15, that's where I put this in. It's trading a little higher than that now as Tesla has rallied a bit off today's lows. But this is one that gives you deltas in Tesla with limited risk, only the debit paid, and upside potential, a little bit bigger delta. Now let's get to our second trade because that's similar but a little different, using all the same dates for a truck like Rivian. Now here's what Rivian is doing. It's not as sexy as Tesla, but if you've seen the cars and if you're driving around Chicago or Illinois, remember these are made in downstate Illinois. They are attractive cars. They are good looking and they are all over the place, growing and growing in the suburbs of Chicago. I can just say that about my area. But now they're focusing on long-term growth and they're aiming to produce over 600,000 cars by the end of the decade, but they're having some short-term problems. They had some part issues that had made them lower production. They're retooling some of their factories to get ready for the R2 and the R3, two new autos coming out by Rivian. They're not focusing on things like short term. They're focusing on cost reductions and retooling and getting ready for the long term. Why? Because one of the things they talk about with Rivian is they lose money every car they sell. Well, when they get the scale up, that'll take care of the fixed costs and change that. So that's what this company's doing. It's just not worried about the short term as much as they are planning for the long term. And that's a really good way to look at a business from the long-term perspective. Remember, Volkswagen, that is cutting back some of their own production, put $5 billion into Rivian. So the investments are coming. They've got enough capital. Now they're just trying to roll out two more cars, the R2 and the R3, to get that production level up to 600,000. That said, it's got a current market cap of only $10 billion. So if you think that Rivian has a positive future, remember, it can be Tesla, it can be DeLorean, frankly, and it's still not 100% sure, but this company looks like they're putting out a quality EV product, and it looks like they have enough cash. They're building their brand out. They're building out their platform. They're going to produce about between 47 and 49,000 cars in 2024, and their pace is just slower and more methodical, and they're bringing out more cars, but they're focusing on, like I said, their long-term strategy, not worrying about the short-term setbacks in some of their production. Now let's get to the trade. This trade is in the same family, same dates, November 29th, November 8th. But instead of calling this a diagonal, it's in the diagonal family, but we're actually calling this a stock replacement strategy because we're buying an in-the-money call, right? We're buying the 9 strike call, even though Rivian is trading current now about 10.07 a share. We're buying the 9 strike call, selling the 11 strike call in November 8th. And that's trading about, we have it in for $1.30. It's trading actually a dime less than that now. It's only trading $1.20. So this is a 70 delta call that we're buying. Might be slightly less than that now as the stock has moved a little bit lower, but we're buying a deeper in the money call to replace the stock that we're buying, right? The $10 stock. This is only the net, the total debit on this trade is $1.30. That's all the risk you have on this trade is the debit paid. So you're doing it, if you think of it, a Rivian trading $10 and you're doing this for $1.30, just over 10% of the original price is what you're paying for this. It still collects data every day. It's still got that same diagonal look, as you can see on the profit chart there, but this one is lower risk than doing a covered call strategy, right? Because covered call, you have a risk all the way down to zero if you buy Rivian stock for $10. This one, you're doing very similar upward exposure, but only for $1.30 net debit. So 2 ways to look at a diagonal, one with an at-the-money call going higher, one with an in-the-money call, which we also refer to as a stock replacement strategy. So buying the further out call instead of buying the underlying in Tesla and in Rivian, selling the out-of-the-money call against that so you're collecting theta. These are 2 ways to buy these stocks for a less expensive, less capital outlay, and lowering your overall risk. All right, that's all for today's Daily Trader. I'm Kevin Hincks. Have a great day, everyone. We'll see you tomorrow with another edition of Daily Trader.